So if you just glanced at the headline numbers at 4:00 p.m. today, Monday, August 24th, 2026, you would probably assume that Wall Street had just completely checked out for the remainder of the summer.
Oh, yeah, totally sleepwalking.
Right.
Yeah.
I mean, the S&P 500 closed at 7,083.35, which is down this microscopic 0.03%, and the Nasdaq slipped 0.02%, and the Dow lost just 0.07%. So it is a complete unmitigated flatline on the surface.
It looks like a total pause.
Yeah. But that's exactly why we're doing this deep dive into today's post-market research brief, because beneath those static numbers, we're looking at one of the most violent structural rotations of capital the entire year.
It is a massive divergence. I mean, the broader indices are essentially just sleepwalking, hovering roughly 2% off their all-time highs.
Right.
And that gives this illusion of total market stagnation. But when you dig into the post-market data that we're analyzing today, the capital isn't sitting on the sidelines. It is furiously reallocating in ways that, frankly, fundamentally alter the market's architecture.
Which brings us to the most glaring anomaly on the tape today. While those mega-cap tech stocks were basically paralyzed, the Russell 2000, the index tracking small-cap stocks, it completely detached from the broader market.
It really did.
It gained over 10 points today, up 0.34% to close at 3,078.84. And that is not just a solid green day. That is a brand new record high for the small-cap sector.
And that right there is the signal in the noise.
Yeah.
When your major cap-weighted indices stall out like that, but small caps break out to unprecedented highs, you are witnessing a mechanical rotation. The market is finally experiencing breadth expansion.
Okay, let's unpack this mechanic for a second, because for the better part of the last 2 years, this market has been entirely top-heavy.
Oh, completely.
Right, if a portfolio wasn't concentrated in those 5 or 6 magnificent mega-cap tech names, you were essentially just treading water. Now, it feels like we're seeing the pressure valve finally release.
Exactly. You can think of it like a massive hydroelectric dam. For years, all the capital, the water in this analogy, was pooled in a single massive reservoir at the very top. The mega-cap tech monopolies.
Right.
But those valuations have reached this sort of saturation point. The returns on the next $1 billion invested up there are diminishing. So the market is opening the spillways, and that capital is cascading down into the secondary and tertiary channels.
And the brief specifically identifies this flow targeting small-cap value and AI infrastructure, right?
Yes, exactly.
And the specific names the research highlights are fascinating to me. Nebius, trading under the ticker NBIS, and SanDisk. We aren't talking about the companies designing the foundational AI models anymore.
No, not at all.
We're talking about the physical, unglamorous plumbing required to make those models actually function in the real world.
Because the market has finally priced in the physical limitations of artificial intelligence.
Right.
You can design the most sophisticated neural network on the planet, but it cannot run on code alone. It requires these vast, sprawling data centers.
And a lot of hardware.
Tons of it. Those facilities need specialized solid-state memory storage, which is where a mid-cap player like SanDisk captures the flow. They need high-density networking hardware, advanced liquid cooling systems, massive power transformers.
It grows the realization that building out this multi-trillion-dollar AI ecosystem requires a physical supply chain that the mega caps simply do not manufacture. I mean, they design the chips, but they rely on mid-market companies to build the racks to hold them, right?
Exactly.
Yeah.
And the capital is front-running that reality now. The investment thesis has moved past the intellectual property of AI and into the industrial application of it.
Which is huge.
Yeah, companies like Nebius are positioned exactly where that capital is flowing, right into the specialized, localized data center expansion.
But that raises a really critical question about the mega caps themselves. If the capital is flowing down to the infrastructure layer, why is the top layer, the tech giants, why are they completely paralyzed today?
Well, the brief makes it abundantly clear. The entire global market is effectively holding its breath for Nvidia's earnings report this Wednesday.
Yeah, the Wednesday report.
It is the absolute gravitational center of the week.
I understand Nvidia is the bellwether, but I want to challenge the premise here just a bit. Like, are we genuinely at a point in market structure where tens of trillions of dollars in global equities are essentially held hostage by a single company's whisper numbers on a random Wednesday in August?
It's crazy to think about, but yeah.
Because the official consensus estimates are one thing, But the whisper numbers, those unofficial elevated targets that trading desks are actually modeling for, they seem to be demanding absolute perfection.
They are demanding perfection, and yes, the market is completely captive to it, but to understand why, you really have to look at the massive tension between the two opposing forces driving Nvidia's revenue right now.
Okay, break that down for me.
So on one side of the ledger, you have the traditional consumer hardware cycle, which is aggressively cooling off. The everyday consumer is tapped out. We are not seeing that frantic pandemic-era upgrade cycle for laptops, graphics cards, smart devices.
Right. Everybody already bought what they needed.
Exactly. If Nvidia were still operating purely as a consumer-facing hardware company, their valuation would be entirely unsustainable today.
Because consumer hardware operates on a standard replacement cycle. You buy a laptop, you don't buy another one for, 3 or 4 years.
Precisely.
But Nvidia isn't relying on the consumer anymore. They are relying on a concept the brief explicitly flags, which is sovereign AI spending.
This is the counterweight, and it is reshaping global macroeconomics.
Wow.
We have moved far beyond corporate IT budgets. We are now watching entire nations, sovereign entities, taking on monumental levels of debt to build their own localized AI infrastructure.
Okay, I get the strategic angle of a nation wanting its own AI capabilities. But let's be realistic about the scale here. Can sovereign government spending actually replace the velocity of a global consumer base?
That's the big question.
Right. I mean, Apple sells millions of devices every single day. A sovereign nation builds a massive data center once, maybe twice a decade. Is that sporadic state-level purchasing really enough to hold up a multi-trillion-dollar valuation and offset a consumer slowdown?
It is a phenomenal question, and the answer lies in understanding what sovereign AI actually represents.
Okay.
It is not a one-and-done infrastructure project like building a bridge or a highway. It is an ongoing computational arms race.
An arms race.
Yes. Nations have realized that AI is a matter of absolute national security, economic survival, and crucially, data sovereignty.
Data sovereignty.
Yeah.
Meaning, for example, the French government does not want its citizens' most critical health, financial, and military data being processed on commercial servers located in Virginia, right? Where it's subject to U.S. jurisdiction.
Precisely. To protect their data, they must build their own sovereign clouds. But they don't have the domestic technology to do it, so they have to buy the infrastructure from companies like Nvidia.
Wow.
And because the models are constantly evolving, requiring exponentially more compute power every 6 months, these governments are locked into a perpetual upgrade cycle. It is a bottomless well of demand.
So the customer base has fundamentally shifted from, gamers and tech CEOs to prime ministers and defense departments.
Yes, and that is why Wednesday's whisper numbers are so critical. The market doesn't just want to know if Nvidia hit its revenue targets.
Right.
Institutional investors need granular proof that this monster wave of AI debt, as the brief calls it, is deploying fast enough and at a large enough scale to completely vaporize the consumer hardware slowdown.
And if it doesn't?
If the sovereign spending narrative shows even a hairline fracture, the entire tech sector reprices downward.
Man. Which brings us to the bedrock of this entire operation. Because nations cannot fund trillion-dollar AI data centers out of petty cash.
No, they cannot.
They need to borrow massive amounts of capital. And that requires a stable, highly liquid bond market. Which brings us to the macro plumbing side of today's brief.
The true engine room of the global economy.
Right. And we saw significant movement in that engine room today. The 10-year Treasury yield eased down to 4.70%. Just on Friday, it was sitting at 4.74%.
Yeah, quite a move.
Now, 4 basis points doesn't sound like a massive move to a casual observer, but we are talking about a crucial retreat from the grueling 20-month highs we've been staring down. And the brief does not attribute this drop to natural market demand. It points directly to intervention by the U.S. Treasury Department.
Specifically, the utilization of the Treasury General Account, the TGA.
So let's break down this mechanism, because the way the Treasury is utilizing the TGA right now is aggressive.
Very.
Secretary Bessent is essentially using the TGA, which is the government's operational checking account, to execute nearly $1 trillion in bond buybacks. Yeah. He is deploying a $1 trillion hammer to artificially force bond prices up, which mathematically forces the yields down. But I have a hard time believing that an intervention of this magnitude comes without a severe cost. You can't just cap yields artificially without something else breaking.
You absolutely cannot. And the collateral damage of this operation is the U.S. dollar.
Okay, how so?
Well, When the Treasury artificially forces U.S. yields down, U.S. debt becomes significantly less attractive to foreign investors who are chasing yield globally.
That makes sense.
If a foreign institution can get a better natural return in European or Asian debt markets, they will route their capital there.
Right. Less demand for our bonds means less demand for our currency to buy those bonds.
Exactly. The capital outflow directly weakens the dollar. So the Treasury is executing a highly fragile balancing act.
Yeah.
They are choosing to suppress long-term borrowing costs to keep the domestic economy and this massive AI infrastructure boom breathing, but they are doing it by sacrificing the purchasing power of the currency.
Essentially importing inflation to save the bond market.
That is a very stark, accurate way to frame it. And the real danger is that this artificial stability in the bond market is incredibly vulnerable to external shocks.
And the brief outlines a dashboard of overnight risks that could instantly blow up this entire Treasury operation.
Oh, absolutely. The geopolitical tripwires are everywhere right now.
Let's look at the Persian Gulf. The brief notes that Brent Crude slumped 2.3% today, closing down at $90.54 a barrel. On paper, falling oil prices should be great news for inflation and great news for those Treasury yields. But the brief warns this is a mirage.
It is a total mirage, because that $90 floor is only holding because the market has already priced in a sustained environment of high energy inflation. The drop today was technical, not fundamental.
So what's the fundamental reality?
The fundamental reality is that the U.S. Treasury is preparing to level secondary sanctions this week against a major financial institution tied to Tehran.
Wow. And the diplomatic pressure is already fracturing their local economy. I saw the Iranian Rial hit a record low against the U.S. dollar today.
Which means the economic warfare is actively escalating.
Right.
The market is entirely exposed to physical retaliation at this point. Any escalation in the Gulf, a disrupted shipping lane, an attack on energy infrastructure, it instantly reverses today's crude slump.
It goes right back up.
Exactly. That $90 barrel could violently gap up to $110 or $120 overnight.
And if oil spikes, global inflation spikes. If inflation spikes, the 10-year yield shoots right back up, and Secretary Bessentree's trillion-dollar TGA hammer suddenly isn't heavy enough to keep the yields capped.
The entire artificial ceiling collapses, and honestly, it doesn't even require a geopolitical crisis to trigger it. The brief also highlights domestic threats, specifically Hurricane Lala.
Right. Commodities traders are aggressively tracking its projected path right now. It currently threatens a significant portion of Gulf Coast energy infrastructure by midweek.
Yep.
It is another massive external shock to energy prices that the Federal Reserve and the Treasury are completely powerless to control.
And this fragility is bleeding into sectors you might not immediately associate with macro plumbing. The brief notes that IT services was actually one of the weakest sectors in today's market.
Which feels super counterintuitive during an AI infrastructure boom, doesn't it?
It does, until you look at the mechanism driving the weakness. The brief attributes the lag in IT services directly to anxieties over the rising U.S. federal deficit.
Ah, so investors are connecting the dots.
Exactly. They see the government running a massive deficit, utilizing operations like the TGA buyback just to keep the bond market stable.
It's a paradox. The government is spending historic amounts of capital to suppress yields, but that very debt load is terrifying the investors who fund government contractors. The market assumes that to service this ballooning debt, the government will eventually have to slash its everyday operational spending, which means cutting lucrative federal IT contracts.
It is the ultimate snake eating its own tail.
Yeah.
The debt required to stabilize the system is beginning to suffocate the contractors relying on that system.
And here is the truly unnerving part about all these risks. The Iranian sanctions, the hurricane forming in the Gulf, the deficit anxieties, none of these forces care what time it is in New York.
No, they don't.
A geopolitical flashpoint or a hurricane trajectory update does not politely wait for the 9:30 a.m. opening bell. Which brings us to the final and arguably most structural evolution detailed in this brief.
The obsolescence of the market close.
Here's where it gets really interesting. The Depository Trust and Clearing Corporation, the DTCC, they're actively in an industry-wide testing phase to transition the equities market to near-continuous 245 trading.
It's wild.
They're targeting a full rollout between June 2026 and 2027. We are looking at the death of the traditional market structure as we know it.
It is a monumental rewiring of global capital flows. I mean, we are used to extended hours, sure, pre-market and after-hours trading, but those are fragmented, low-volume environments.
Right.
Transitioning to a true, continuous 245 clearing of equities alters the fundamental mechanics and psychology of price discovery.
From the perspective of a retail investor, I mean, this sounds incredibly empowering on the surface.
Right, on the surface.
Under the current system, if a massive geopolitical event happens in the Middle East at 3:30 a.m. on a Tuesday, or a sovereign wealth fund announces a trillion-dollar AI chip order on a Sunday night, the everyday investor is trapped. You just have to sit there, watch the overnight futures plunge or spike, and pray your portfolio survives the violent gap at the 9:30 a.m. open.
Exactly.
But in a 245 market, you have agency. You can actually execute a trade at 4 a.m. You aren't locked out while institutions quietly maneuver.
This raises an important question, though, because that is the marketing pitch, certainly. It sells this illusion of democratization. But we have to separate access from liquidity because they are entirely different mechanical concepts.
Okay, break that down.
The brief specifically flags that regulators are monitoring for overnight liquidity gaps during these tests, and that is where the danger lies.
Explain the mechanics of that danger. Why is executing a trade at 3 a.m. fundamentally more dangerous than executing that exact same trade at 11 a.m.?
Well, during standard New York market hours, the market possesses deep, resilient liquidity. There are millions of active participants and, crucially, institutional market makers providing constant bids and asks.
The order book is thick.
Very thick. If a negative news catalyst hits at 11 a.m. and you want to sell 1,000 shares of a tech stock, the market absorbs that order with minimal price disruption.
But overnight, that depth just vanishes.
It evaporates. The primary market makers, the deep institutional liquidity pools, they are not operating with the same volume or risk tolerance at 3:00 a.m.
Wow.
When you remove that depth from the order book, the market becomes incredibly brittle. If that same negative news catalyst hits overnight and you and thousands of other retail traders panic and hit sell, there isn't a deep pool of buyers on the other side to absorb the shock.
So the algorithms just pull their bids.
Instantly.
Wow.
And because there is a liquidity void, the price has to gap down violently to find the next willing buyer. A relatively small volume of panic selling could trigger an algorithmic cascade, cratering a stock 10% or 15% in a matter of seconds. Jeez. So yes, the retail investor gets access to the arena at 3:00 a.m., but they are stepping into an environment where price discovery is fundamentally broken, and the slippage on their execution could be devastating.
It's like you are essentially giving everyday investors the right to swim in the ocean long after the lifeguards have gone home, right as a massive storm is rolling in.
That's a perfect analogy. It is a recipe for extreme, localized flash crashes occurring in the dead of night.
This has been a deeply revealing look at a market that only appears to be resting. Let's briefly recap the actual state of play for our listeners here.
Sure.
Beneath the illusion of today's flatline indices, we have the Russell 2000 surging to record highs as breadth expansion forces capital out of exhausted megacaps and down into the mid-cap AI infrastructure plumbing, names like Nebius and SanDisk.
While simultaneously, those mega caps are paralyzed, completely captive to Nvidia's upcoming earnings, waiting to see if massive sovereign AI debt can truly offset a dying consumer hardware cycle.
Right. And we looked at the extreme fragility of the macro plumbing, where the Treasury is weaponizing the TGA to hammer the 10-year yield down to 4.70%, fully aware that this artificial ceiling weakens the dollar and could be shattered instantly by geopolitical tripwires in the Persian Gulf or a hurricane in the Gulf Coast. And looming over all of this is the impending reality of 245 equity trading, promising retail access but threatening severe overnight liquidity gaps.
It is an ecosystem balancing on a razor's edge, highly engineered and deeply susceptible to external shocks.
Which provides the perfect context for the analyst's final takeaway in today's brief. They wrote, and I quote, "The trend is currently your friend in small caps, but the concentrated bet on AI infrastructure faces its ultimate test this Wednesday. Tighten your stops and keep an eye on the 10-year. It is a mandate for a defensive posture."
It absolutely is. And as we close out this analysis, there is a systemic collision I want to leave you considering.
Okay, well, let's hear it.
We unpacked two massive structural shifts today. Sovereign AI, which is entire nation-states deploying limitless capital and algorithmic power to secure data sovereignty, and the imminent arrival of a 245 continuously clearing global equities market.
Okay, the combination of those two forces.
Think about the implications. We are rapidly approaching a paradigm where the very concept of a market close or a safe weekend ceases to exist.
Wow.
Everyday investors will no longer just be navigating around Wall Street institutions operating on New York time. They will find themselves trapped in a perpetual, round-the-clock arena, forced to compete in an algorithmic arms race against sleepless, state-backed AI entities capable of processing geopolitical data and executing massive capital rotations at the speed of light at 4 a.m. on a Sunday.
Man, it fundamentally changes what it means to be a participant in the market. That is a sobering reality to prepare for, and exactly why we look past the headline numbers. Thank you all for joining us on this deep dive into the tape. Keep questioning the mechanics behind the surface, tighten those stops, and we will see you next time.